We've introduced you to the basic financial statements. We've talked about a little bit more in depth the pieces of the classified balance sheet. Now what we're going to do is we're going to really work on giving you an understanding of what all this information really tells users and its benefits for the variety of users, be they creditors, lenders, investors, vendors, so on and so forth. Those benefits are both internal and external, because remember, accounting information does serve both purposes. One of the key ways that we take that information, that all the transactions, those economic events, result in, and relate it to something quantifiable and measurable, is that we use ratio analysis. So ratio analysis is one of the ways that you can take a value and relate it mathematically to something else. In doing that, what we can do largely with most of the ratios is we can disregard the noise that the dollar value can create. Part of the benefits of financial statements for the various users is that they can compare similar companies one to another. With ratio analysis, they can remove the noise of $3 billion and look at it in regards to something else. We introduce you to some of the basic ratios and their uses in profitability, liquidity, and solvency in this class. We continue to build on that through this class, looking at some of those things, but you will use these types of ratios in other business classes as well. Ratio analysis is the expression of the relationship among selected items amongst the financial statement data. They express the mathematical relationship between one quantity or another to shed light on company performance. Now, a single ratio, just doing the calculation, doesn't really tell us a whole lot by itself. What it does is it gives you a measure. Apologies, as it appears that there might be a bit of a problem here. Okay, back at it. So what the ratio analysis does is it provides us with a value that we can use for comparison purposes. There are three types of ratios. There are profitability ratios, which measure the income or the operating success of a company for a given period of time. There's liquidity ratios, which measure the short-term ability of the company to pay its obligations or meet their unexpected needs for cash. And then there are solvency ratios, which are the measure of the ability of the company to survive over a long period of time. When you're calculating ratios, you're often going to end up with a very long trailing decimal. Standard is to round that decimal to either 3 or 2 places. Honestly, for sake of ease, there are a couple of ways that work to compute your ratios. You can compute them pen and paper. I typically will use Excel spreadsheets to calculate my ratios. And when you are calculating ratios, it's important to look at it to see, really, does this number make sense? Because what you may have done is you may have picked up a value somewhere else that isn't correct. You always want to think about what the ratio actually tells you, and we'll talk about that in these ratios that we're going forward with. such as earnings per share, working capital, the current ratio. What does it tell me? Not only should you be able to make the computation, but you need to know what that ratio is telling a user. Some of the ways that we have of understanding our ratios is by looking at them either intra-company, which is a comparison over 2 years for the same company. We can do it by taking our ratio that we have now calculated and comparing that to, say, an industry average. This is a comparison where the average ratios for the industry are calculated. How are we doing compared to the industry as a whole? We can do it inter-company, which is where we take our comparisons and then utilize the financial statement data of a competitor and compare ourselves to them. There are many ways that you can find industry averages and ratios in the web or in the library. Another way you can do that is by utilizing CalcBench, which is a tool that we here at CMC have. While you're going through your business programs, I would really like to encourage you to start watching shows on the financial networks, reading business sections of the newspapers, and I know that means doing it online. Reading some of the business periodicals, such as the Harvard Business Review, the Journal of Accountancy. All of these are really great resources that you should start familiarizing yourself with now at this early stage of your business program. If you've run across something interesting, share it in the discussion board, share it with your classmates, share it with your friends. When we're using financial statement data, we often use 2 years or more worth. So here we're looking at Best Buy Company's income statement. And this is for the 12 months ended February 1st, 2014, and for the 11 months ended February 2nd, 2013. It's basic income statement. We have revenues, expenses, income tax expense, net income or loss. Creditors and investors are very, very interested in evaluating profitability. Profitability is frequently used as a way to see whether or not management is effective in generating a profit through operations. As a supplement evaluation of the income statement, often ratio analyses are used. Profitability ratios are overall the measure of the operating success of the company for a given period of time. Remember, your income statement looks at a period of time. One of the key ways this is done is with what we call EPS, or earnings per share. This is a profitability ratio that measures the net income earned on each share of common stock. So for every share of common stock, how much in earnings was yielded? We compute it by dividing our net income less preferred dividends by the average number of common shares outstanding. So this is not the value of common stock, this is the actual number of shares. By comparing earnings per share of a single company over time, so if we looked at 2013, 2014, 2015, 2016, we can begin to evaluate the relative earning performance of a single share. Comparisons of earnings per share across companies really aren't meaningful because there's just a really wide variety in the number of shares that are outstanding in stock from company to company. So let's do the calculations here for EPS, or earnings per share, for 2014 and 2013. So we take our net income less our preferred dividends. If net income is $532 and we have $0 in preferred dividends, then we start with $532. Then we divide that by the number of shares or weighted average common shares outstanding. And to do that, we take what the shares were at the beginning of the year, add what the shares are at the end of the year, and we divide that by 2. You're going to hear a lot of things about average when it comes to ratio analysis. By and large, typically when you see that, what we're doing is we're going to take what the beginning of the year was, what the end of the year was, and divide it by 2. So EPS for 2014 is $1.55. Now remember, these are in millions. Let's look at 2013. We have net income less preferred dividends. We didn't actually have net income, we had a net loss. When you see the parentheses around a value like this, you'll see over here where it says loss in parentheses, that means that we had a loss. So we have a loss of $441. And we need to divide that by the weighted average common shares outstanding. So 341 plus 338 divided by 2. And that will yield us $1.30, or negative $1.30, my apologies. As you can tell, earnings per share wise, this company is now actually performing over 200% better. Because to get to 0, it would have been $1.30. We have another $1.30, and that's still less. That's 200%. We get it to a positive $1.30. What the company did in this particular year would be great to look at to see if it is duplicatable or is it extraordinary. You'll hear me use words like extraordinary events, and this means something that happens every now and then that you cannot necessarily plan for, but that yields some type of an impact on the financial statement data. So I want you to take a minute here. And for 2017, Stolen Corporation reported net income of $26,000. They had net sales of $400,000 and average shares outstanding of 6. There were preferred stock dividends of $2,000. So what is the 2017 earnings per share? Let's start with net income of $26,000. There is reported preferred stock dividends of 2, so we need to reduce that by 2,000. And that gives us 24,000, right? We take 24,000 and we divided it by the weighted average shares of common stock. They tell us that our average shares outstanding is 6,000. So we divide that by 6,000. That gives us $4 of EPS. Again, a standalone number doesn't tell us exceptionally a lot other than for every share, there was $4 of earnings generated. When we look at what happens across periods from one to the next, we can begin to see a performance trend. You're going to use the classified balance sheet and ratio analysis. An analysis of the relationship between the company's assets and liabilities can really tell a user a lot about the firm's liquidity and their solvency. So we'll be using Best Buy Company's balance sheet here. We're going to start by talking about liquidity. Liquidity is the ability of an organization to pay the obligations that are expected to become due within the next year, the operating cycle. Here, that next year, the operating cycle. So you know that there's some emphasis here on current. there are a couple of key measures of liquidity. The first one is working capital. So this is a measure of the firm's short-term ability to pay obligations. That particular formula is current assets minus current liabilities. So Best Buy had working capital in 2014 of $3,049 million. That is $10,485 million in current assets less $7,436 million in current liabilities. This tells us that how much of the current assets are left if we satisfy all of the current liabilities. Positive working capital, so having a positive number, is going to indicate that the likelihood for paying the liabilities is favorable. The more positive it is, the more favorable that is. Negative working capital, when your current liabilities are greater than your current assets, is an indication that the company may not be able to pay their short-term creditors and might be forced into bankruptcy. Now, while these are general rules of thumb, they are not 100% gospel. They are not black and white rules. These are just general rules of thumb. The second liquidity ratio is the current ratio. And that is taking our current assets and dividing them by our current liabilities. And this is a measure of the short-term ability to pay obligations. This is considered a more dependable indicator of liquidity than working capital. But neither of these take into account that amongst the current assets, there are some slower converting ones. So think about slow-moving inventory versus cash. Cash is definitely going to be more liquid than slow-moving inventory. With the current ratio, as you can see here for 2014, where we actually have it calculated, it's 1.41 to 1. So this says for every dollar of current liabilities, Best Buy has about $1.41 of current assets. So in 2013, that was $1.11 to 1. For H.H. Gregg, which is a competitor, they're $1.68 to 1. But the industry average is 88 cents to 1. The actual composition of the assets is very important. If more of the current assets are slower moving or things like prepaid expenses, the company is not going to be as liquid as the value actually indicates. If the larger percentage of the current assets are in things such as short-term securities, notes payable, accounts receivable, and cash, the company is a little bit more liquid than just the ratio indicates. So your book has this particular little article within it that says, can a company be too liquid? And it is actually very true. There is a well-known situation where Apple, everybody knows who Apple is, iPhones, iPads, computers, Apple TV, you name it. Where Apple was actually admonished for being too liquid, and it resulted in some special dividends being distributed to their stockholders. I encourage you to look up articles related to this. Google Apple liquidity, Apple too liquid, and read those articles and see what the industry and what the analysts had to say about Apple's position and how Apple responded to that. Solvency is the ability of an organization to pay interest as it comes due and to repay the balance of debt due at the point of its maturity. This is a measure of whether a company is going to survive over a long period of time. There are several types of solvency ratios. You'll notice here in the hints that some users will take the stockholders' equity total and divide that into the liabilities. This is the debt to equity ratio. The higher this is, the lower a company's solvency. We want them to have a high solvency. Another one is the debt to assets ratio, which is a measure of the percentage of the assets of the organization that are deemed to be financed by creditors. The higher the percentage of debt financing, the riskier the company is, both to investors and creditors. You calculate this by dividing total debt, so that is both your current and long-term liabilities, or the total liabilities on the balance sheet, by total assets. So in 2014, Best Buy was at 72%. This means that for every dollar of assets, they were financed by 72 cents of debt. In 2013, they were at 78%. H.H. Gregg is at 51%, but the industry average overall is at 88%. So comparatively, while Best Buy is not doing as well as maybe their main competitor, they are doing better than the industry average, and they are doing better than they did in the prior year. So ratios are much like tests that are performed by doctors. Not everybody's normal resting body temperature or their beats per minute of their heart are the same. What's normal for me may not be normal for you. So you have to ask a lot of questions, the doctors do, and the same thing with business. We have to ask a lot of questions. We have to look at what the numbers tell us before we really come to a conclusion. While ratios are indicators, they have to really be analyzed before a decision can really be made about what the financial condition of the company is. There are a lot of other things to take into consideration. So like we said before, with a negative working capital is typically not a good idea, but it doesn't always mean potential bankruptcy. There are a lot of companies that run frequently with either a very low or a negative working capital. It is part of their management plan. This is the same across other companies. You just can't look at the number and make a judgment. What you have to do is you have to look at that number, compare it to something that's same value within the organization for prior periods, against the other competitor, so intercompany, or against the industry average. Additionally, while one ratio may be looking like it may be a poor indicator, perhaps there's something in the other ratios that is explanatory for why this is. So debt is not always bad. Depending upon your industry and the company, there are different levels of debt ratios that are normal. Here we have some debt to asset ratios for some companies for a recent year. So Google's only usually at 23%, Nike's at 41%, but you notice as we continue down and we look at General Motors at 74%. Now, yes, I'm aware that they had to be bailed out. There's a lot of issues, but for the automotive industry in general, they tend to run a high debt to asset ratio. So in the statement of cash flows, which we have shown you, you get cash provided by operating activities. This is an indication of the cash generating capability of the company. However, cash provided by operating activities really fails to take into account and doesn't take into consideration that in order to continue to operate, say at that level, the company is going to need to invest in regular plants, property, and equipment, and at minimum, maintain dividends at current levels to satisfy their investors. So to calculate for those considerations, there's free cash flow. Free cash flow is an indication of the company's ability to generate cash from operations that is sufficient to pay their debts, acquire their assets, and distribute dividends. It describes the amount of cash remaining from operations after adjusting for capital expenditures and dividends. So in order to just maintain status quo, what is necessary, and then what is left. We calculate this by subtracting capital expenditures and cash dividends from the cash provided by operations. Here we have MPC, who produced and sold 10,000 personal computers this year. They reported $100,000 cash provided by our operating activities. In order to continue to maintain production at 10,000 computers, they invested in $15,000 worth of equipment and chose to pay $5,000 in dividends. So their free cash flow is $100,000 less $15,000 in equipment, less $5,000 in dividends, leaving $80,000 in free cash flow. So our next video will really talk about financial reporting concepts. We have shown you what the financial statements are, what we have to make. We have looked at them a little bit more in depth to start with. Remember, we'll really dig into different pieces of this in future class sessions. Right now, we're just kind of getting you a little wet behind the ears at this point, trying to get you to understand how those financial statements are interrelated, what the composition of them are, such as the classified balance sheet, and why there might be classifications, what the usefulness of this information is. A lot of people say accounting information is only good for accountants, and that's really not true. Accounting is the language of business. And using that language and looking at these numbers and using things such as ratios, not just financial statement ratios themselves, but even internal ratios that may apply to managerial operations, then we can set standards, we can make goals, we can see what our progress on the goals are. How are we doing compared to other people? How are we doing compared to ourselves? Did this plan work to increase the things we needed to increase or decrease the things we needed it to decrease?